All right, welcome back to the Explainer. Today, we're going to break down the language of price movement. We're talking pips, points, and ticks. Ever wondered how traders track those tiny little shifts on a chart? Well, stick around because that's exactly what we're digging into.
So, let's start with a really simple question. When the price of something moves, what do you actually call that smallest possible step? You might think there's one simple answer, but, well, it's a little more complicated than that. And here's why. The answer totally depends on what you're trading. It turns out different markets have their own lingo for the exact same thing, that minimum little price jump.
Okay, first up, Forex. Let's talk about measuring in pips. We'll start with the biggest market in the world, foreign exchange. And in Forex, it is all about the pip.
So, what is a pip? It's short for percentage in point, and it's basically the standard unit we use to measure any change in a currency pair's value.
And they are tiny. I mean, just look at this. For most currencies, a pip is all the way out at the fourth decimal place. So if you see the euro/dollar go from 1.0850 to 1.0851, boom, that's a one-pip move.
And this isn't just some abstract concept. You'll see it in action all the time. Tools you might already be using, like the average true range, the ATR, literally measure a market's volatility in pips. That's its language.
All right, so that's Forex. But what happens when we jump over to other markets? Let's talk about indices and futures, because here we're dealing with points and ticks.
You see, the lingo just completely changes. We're not saying pips anymore. If you're trading indices, you're tracking points. Those are the whole number moves. And if you're in the futures market, you're counting ticks, which are the smallest fractional moves.
And get this. This is how important it is. Pro trading firms actually make their new traders run drills, kind of like this exercise here. They'll set profit targets in points and stops in ticks over and over again. Why? To build that rock-solid, machine-like discipline right from the get-go.
So we've got pips, points, and ticks, three different names for what sounds like the same thing. So what's the unifying rule here? How does this all connect?
Well, it's actually pretty straightforward. Each market just has its own special name for its smallest move. It's pips for Forex, points for indices, and you guessed it, ticks for futures.
And here is the absolute key takeaway. The language changes, right? But the math does not. A minimum price change is a minimum price change, no matter what you call it.
Okay, so why are we hammering this home? Why does this even matter? Because this isn't just a fun fact. This is the bedrock of the single most important thing you'll ever do as a trader, managing your risk.
I mean, listen to the pros. As the folks at Pivot Boss say, risk management is the most important aspect that separates professional traders from the rest. It's literally the thing that makes or breaks you.
So you see, the real question you should be asking yourself isn't, hey, what's this little price move called? That's just vocabulary.
No, the only question that matters is this. What is one pip, 1 point, or 1 tick worth in actual dollars for your trade?
You absolutely have to know the dollar value of a single move, because that value, that defines your real financial risk. It's what turns those wiggles on a chart into actual money won or lost. And you have to calculate it before you even think about clicking that buy or sell button.
So, before you place your next trade, I want you to ask yourself this. Is it just a guess, or is it defined with precision by the dollar value of every single tick? Your answer really says it all.